Since our last chat, I have started reading The Intelligent Investor and appreciate the mix of stories because that was on the back of our, one of our previous conversations about, reading to sort of to become, to invest in yourself. And appreciate the mix of stories that Graham uses to connect the reality side of investing, and specifically the story of Sir Isaac Newton, who lost 22,000 euros roughly, which was be about 3 million in today's terms, due to FOMO. Now, your advice is to invest in yourself. Is there something else you can elaborate on with this example from The Intelligent Investor?
I think that's a great example. There are 2 chapters in The Intelligent Investor that you have to read that will cause you not to be Isaac Newton. One is margin of safety. Isaac Newton knew a lot about some things, but he didn't pay any attention to the fact that the company that he was investing in had a lousy balance sheet. And he put all his eggs in one basket. If you put all your eggs in one basket, you better know that basket. That's something he didn't do. The other thing that Mr. Newton forgot, that's a great chapter in The Intelligent Investor, is Mr. Market. Mr. Market has to do with the fact that when you're in the stock market, your partner is the market itself. And the market itself is determinedly narrative-oriented. One day, according to Graham, and I love this analogy, your partner is elated, and he is willing to buy your share of the company, in this case the economy, for twice what it's worth. Another day he's depressed, and he's willing to sell you his share for half what it's worth. Your job is to understand that Mr. Market is a manic depressive and accommodate him both ways. When he's depressed and he wants to sell cheap, you have an obligation to yourself to buy. When he's manic and he wants to buy at twice what it's worth, you have an obligation to sell. When the uranium price 5 or 6 years ago was $20 a pound, and it cost $60 a pound to make the stuff. In other words, when the price had to go up, nobody wanted to buy uranium, right? Mr. Market was depressed. Then the price of uranium went from $20 to $100, went up 5-fold. The narrative was proven by the price action, but the price didn't have to go up anymore, and Mr. Market wanted to buy. Personalizing the lesson in The Intelligent Investor, you buy the stuff when nobody wants it, and you sell the stuff when the markets are clamoring. My own speech about this used to have a title. There was a House Street phrase that said, "When the ducks are quacking, feed them." What that meant was when the chattering classes out there were talking about a certain category of stock, that you print up some certificates and trade them for money. The corollary to that is when the quacks duck, eat them, which means when all the pros and everybody are bearish on a sector, when they are selling back stock to the market that they raised money at 10 times the current share price, you're well advised to stock up. And those are the 2 real lessons in The Intelligent Investor by Graham. There's lots of reasons to read the book, but the key takeaways are margin of safety and Mr. Market.